Financial Modeling, Topic 20, NPV, IRR, and Other Investment Rules. Section 3, we're going to compute the after-tax levered cash flows, FCFEs, for an investment. So we're going to go back to our boating example, and we're going to calculate those levered cash flows, one in which we account for debt and interest. So if we go to our spreadsheet, I have a new tab here. It's FCFE. It's the exact same as FCFF, except I've inserted a couple of rows. I've inserted a row in the income statement up here for interest expense. So now I don't get down to EBIT. I go all the way down to net income. And then when I calculate free cash flows, I'm going to start with net income. And if I get free cash flows to equity, I'm going to start with net income. I'm going to add my three categories before: depreciation, CapEx, salvage, and net working capital. But I inserted a new row here, and these are the loan principal cash flows. So basically, I'm just going to account for the interest and principal cash flows and call that FCFE. And that's really the out-of-pocket cash flows if I were to get a loan. And I'm going to make an assumption. I'm going to buy my boat for $159, and I'm going to get a loan for $149. So I'm going to have a $10,000 out-of-pocket cost to buy the boat. I'm going to get that loan. It's going to be a 10-year loan. It's got an 8% annual percentage rate, and we're going to be 12 payments per year. So the first thing I want to calculate is what is my monthly payment. So I'm going to use the payment function, Excel's payment function. I'll bring that up. I'm going to have the rate. Notice here it says the rate is the periodic rate. So I'm going to take the APR, divide it by 12, and that's going to be my interest rate per period. I'm going to put in a 10-year loan times 12 periods, so it's 120 periods. And where it says payment, I'm going to put in a negative, where it says present value, negative 149. So there's my payment of $18.19 per month. All right, so now we're also going to calculate the interest expense over those 8 years, and then we're going to pay off the loan and pay off some principal and account for that down here. So let's go ahead and calculate a interest schedule for this loan. So this loan is going to start off with a beginning balance of $149, and then I'm going to pay that $149 times the periodic interest, which is going to be the 8%, anchor that, divided by 12. That's the monthly interest rate. So I'm going to pay $999 in interest on the first payment. My total payment is $18.19, anchor that, minus the interest component, and I'm paying $819 down of principal at the end of the first month. I'll take my beginning balance, subtract my principal payment, and at the end of the first month, I now have a balance on my loan of $149,081. That is the beginning balance for the next period. I can then copy these formulas down and then copy all of these down for all 120 payments. And let me go to the bottom and notice, like magic, that last payment is just enough to pay off the balance of the loan, and that ending balance is 0. So if I wanted to know how much interest I would pay in the first year, I would go to the first 12 payments and get the interest for the first 12 payments. So it looks like it's about, if I look at down here, it's $11,623. Notice I have a link in my spreadsheet that does this for me because it's kind of tedious. The sum of the first 12 months interest is $11,623, the next 12 months, and so on. So this is my interest expense for the first 8 years, even though it's a 10-year loan. So now I have actual net income and not EBIT after tax, because interest is not tax deductible. So now I have my net income. Now to calculate free cash flows to equity, I start with net income. I then add back my depreciation, subtract CapEx, add back salvage at the end there, and subtract changes in net working capital. We already did that before for the last problem on free cash flows to the firm. The only other thing I need to account for is all the interest, all the debt principal receipts and payments. So let's think about this. I'm going to pay $159 and put $5,600 in the bank for working capital. However, I'm going to get a loan for $149, so that's going to be an inflow. So my business is not costing me $165 anymore. With the loan, it's only costing me $15,000. However, I need to start paying off that principal. Notice I have a formula here. It's the summing the first 12 principal payments. So if I account for this $10,200, the first 12 principal payments, and this $11,623, that's the sum of the total amount I paid to the bank in the first year, and that accounts for the total debt cash flows. This is the repayment of principal according to the schedule, and this is interest. And so now I have free cash flows to equity. If we compare free cash flows to the firm right here with free cash flows to the equity, you can see what's happening is with a loan, I'm putting less money out today, but then I'm earning less and less cash in the future as I'm paying off interest and paying down the loan. I can now calculate the NPV of that new project. Well, I can calculate all my measures using FCFE. I have my average accounting return on FCFE. Notice it's lower because my net income goes down, but my book value stays the same. My payback goes to 2 years using both discounted payback and payback because I really didn't spend very much today. If I use a discount rate of 12%, my NPV goes from 11 to 47, which means my IRR goes from 13 to 78%. Because it's going to 78% because I only spent $15,000 today, and then I start making 11, 10, 8. So you're getting a high percent of that $15,000. Roughly, if you look at these numbers, the average rate of return you're getting on that $15,000 return, even though the dollars are small, is a higher percent. Versus here, you're getting a high amount of dollar returns, but on a big base. So it looks like this is clearly superior if I just look at these measures, but it's not. The reason why it's not is this is much riskier. What if something happened and my my boat was broken for 3 months? I could go bankrupt. What if I didn't have enough money to pay the first year's principal and interest payments? If I have no debt, I can't go bankrupt. So these are very safe cash flows. They have no, they have a lot of business risk. Both of them have business risk. Maybe the business won't run. However, this one has no financial risk because I don't need to worry about paying off my loan. This has a lot of financial risk, meaning that it's very easy to go bankrupt when you financed a big portion of your outlay with a loan. So it's really unfair to say which one's better. This one's just riskier, and if all goes well, has a higher rate of return and a higher NPV, but it may not turn out well. You may go bankrupt. So on this topic, we calculated FCFE returns and did some standard measures. Now both FCFE and FCFF, so my levered cash flows, my unlevered cash flows, both of those are giving me measure of cash. FCFE is the cash generated excluding debt and interest. FCFF excludes interest. FCFE includes debt and interest. Both of them account for operating profits, taxes, CapEx, depreciation, and working capital. It's just the difference in how it treats debt and interest. Let's talk about some more differences. FCFC's initial free cash flow outlay is lower because of the debt financing. I get some money from the bank, and that's an inflow. But FCS subsequent free cash flows are lower due to the payment of interest and principal. FCFE's IRR and NPVs are often higher, especially if you're not doing sensitivity analysis. And that's because the initial investment's lower. However, FCF cash flows are riskier and should require a higher discount rate. So I probably shouldn't be using the same discount rate for FCFE and FCFF discount rates for NPV and minimum IRR. So on that topic, we calculated levered free cash flows and compared that to unlevered free cash flows and their related investment measures.